Welcome to Wise Man's Dollar, a podcast for everyday working people who want to make wiser decisions with their money, reduce financial stress, and build lasting wealth for themselves and the next generation. I'm Sunjata, and thanks for being here with me once again. So, here's the big idea for today's episode. What if your money could continue growing even while you're using it? That's right, y'all. We're talking about the number two benefit of of whole life, properly designed, dividend paying whole life insurance. And we're in the middle of the eight benefits of whole life series. In the last episode, we talked about the number one benefit, which is the guarantees. Go check that out, y'all. One of the beautiful things about whole life is, especially for the risk adverse people like myself who don't like gambling with their money, whole life is an awesome environment for your savings dollars, right? Because it offers guarantees, meaning you can't lose money. And it also offers a few other guarantees as well. Well, the number two benefit, well, actually, let's talk about all eight, and then so you'll know where we're going with this series. So again, number one was the guarantees. Number two, which is what today's episode is going to be about, is that it offers constant compounding for your money, uninterrupted compounding growth for your money. Number three, it offers liquidity. Number four, privacy. Number five, an income tax free transfer of wealth. Number six, it offers a competitive yield. Number seven, the monthly cash value growth. And number eight, the flexible loan provision. So let's get into talking about the number two benefit, constant compounding. So when we talk about traditional savings and traditional savings patterns, first of all, let's talk about where people normally keep their savings. Normally, we're talking about a regular savings account in your bank that you use for your debits and your credits, etc. And typically, that savings account is getting either no interest or a very small amount, earning a very small amount of interest. Some people save their money as cash, right? And they just keep it in their home, in a safe or, under a mattress. And also, there's high yield savings accounts where people like to save their money. So, and then within those savings environments, the traditional pattern is it goes like this: you save the money, an emergency happens, the account gets depleted, and then you start rebuilding from zero again, right? Well, with the whole life framework, you build cash value. It continues to compound. Then you use policy loans when an emergency happens and when you need that money. And the underlying cash value continues growing, continues compounding. So the reason why this works and the reason why that happens is because you're borrowing against the policy, not from it, like you do if you take money from your savings account or from your cash or your high yield, etc. It's similar to a HELOC in that, you're borrowing against the equity in your home, but that doesn't impact the value of the home. It's similar to that, right? They have a lot of different features between those two, but that similarity remains the same. Your cash value continues working for you because within a whole life policy, you're borrowing against it. So it's like your money is doing two things for you. Your money keeps working even while you're using the capital elsewhere. So let's talk about why this matters, right? So uninterrupted compounding matters because life is expensive. And if there's a strategy where you can have your money doing two things at once, that's pretty exciting. And that's what you get within a whole life policy. We constantly need money for things like vehicle emergencies, right? I literally just got some repairs done to my vehicle this past weekend. There's also, just regular life emergencies where your kids may need something like an emergency, dental procedure or something like that. There's also a need when there's business opportunities and you want to take advantage of something, having cash on hand that you can readily access that's liquid is really beneficial. home repairs, paying for education, investing, or unexpected setbacks. There's always reasons why we need access to our money. And without the proper savings environment, every time a life event happens, it resets your progress, it resets you, it sets your savings back. However, with the proper savings environment like a properly structured dividend paying whole life policy, the growth continues to happen in the background even while you're using your money. And as we all know, it's not a matter of if a life event is going to happen, it's a matter of when, right? So, really, what we're talking about is opportunity costs. Most people think about the cost of borrowing in terms of paying interest, right? We all know how that works, and that's kind of generally, I'll speak for myself. I always thought about and I always tried to avoid paying interest on credit cards. So I never liked borrowing money, taking a, secured loan or unsecured loan from a bank and having to pay back interest, or using credit cards and having to pay back interest, because we all know that you're paying more than the thing actually costs when you do that. But few people think about the cost of using cash and losing the interest that that cash could have been earning when saved in the proper environment. You see, I didn't understand this. And the reason why, again, I said few people, is because most people are like me. We never heard about this asset and the way it works, where, again, your money can continue to work for you even while you're using it. So once you learn about this savings environment, and we call it the proper savings environment, which is, the whole life policy, it just changes everything. I'll give you an example. I was literally recently just talking to my brother about a home improvement project that he just paid for. And he told me that he spent $15,000 for the project. So I gave him the example of how, because he used his cash, his savings, to pay for that work, that money left his system, left his savings environment, and he'll never see it again. And I explained to him that if he had deposited that money into his own banking policy, and when I say banking policy, if you've been following this show, you know what I mean by now, right? Meaning he put that money into a properly structured dividend paying whole life insurance policy. If he put that money there first and then he paid the contractors for the work, his 15,000 would still be earning compounding interest and dividends uninterrupted while that money is being put to work, to get the work done. So the beautiful thing is, when, to contrast that, he had that money in his savings account. He used it for the work, and he's going to continue to, work and build up his savings again. If that money was in the banking policy, it would be the same thing. He would have simply taken out a policy loan, paid for the work, in the same way he would replenish his regular savings account. He would just replenish his cash value again by paying back that loan. But the beautiful thing is, again, he borrowed against his policy, not from it. So the 15,000 is still growing at that number. I hope that makes sense. So one of the things that really changed my thinking on all of this, that helped change my thinking on all of this, is when I read the book Becoming Your Own Banker. And that's when I realized that you lose interest when you borrow money and spend cash. That really was a big paradigm shift for me, because I always thought, paying cash was the best thing. And of course, before I came into the knowledge of what this asset can do, it was. But now my whole goal is to get as much money running through my policy first before I use that cash to pay for things, because I want my money to continue working for me in the background by running it through my banking policy. So that way, I'm not losing the interest that my cash could have been earning. That's the magic of it all. So that really changed the way that I've used savings altogether. And now I look at this as the perfect savings environment for my dollars. So it's a really, really simple concept once you grasp it. And if this is your first time hearing about it, again, I always tell people, check out the book, Becoming Your Own Banker by Nelson Nash. Also, check out the Nelson Nash Institute website, where it talks about the infinite banking concept. in detail. So, the key takeaway from this episode is that whole life is a savings environment where growth can continue to happen while your capital remains accessible. The magic is that your money keeps growing even while you're using it. So that's it for this episode. And in the next episode, I'm gonna go back into one of my personal journey, episodes where I give some insights into like what's going on in my world and in terms of my journey into learning about the infinite banking concept and how I'm using it in my life. And in the next episode, I'm going to be talking about why I decided to become an IBC certified practitioner through the Nelson Nash Institute. So make sure you come back and check out that episode. Thanks again for tuning in to another episode of Wise Man's Dollar. This show is designed to spark curiosity about how people can take control of their money, relieve financial stress, and create intentional wealth using properly structured dividend paying whole life insurance and the infinite banking concept. If you would like to go deeper, visit go.factumfinancial.com/Sunjata, my first name, for free access to a growing library of educational videos and resources. If you enjoyed this episode, hit the like button, subscribe, and drop a comment to share what resonated with you. And share this with someone you care about because wisdom grows when we pass it down. And remember, like my granddaddy always told me, any man can make a dollar, but it takes a wise man to spend it. I'll see you in the next episode.